The floor of the New York Stock Exchange has gone silent only a handful of times in more than 2 centuries, and each silence was bought by a different kind of disaster: a bank run, a crash, a burning building 6 blocks away. What is strange is how much of what happens on that floor, and on every floor and screen that copied it since, was never designed by anyone in particular. Nobody sat down with a blank page and invented the stock market. It grew the way old cities grow, one narrow, half-accidental decision layered on another, until a handshake under a tree became a bell, a rope line became a rule, and a shouted number in a coffee house became the price of a fortune. This list is not going to tell you what to buy or when to sell. That is not what this channel does, and it is not what any of the next 45 stories are for. What they are for is showing you the machinery underneath the word Wall Street and the very human habits that built it. The panics, the corners, the paperwork crises, the shouted hand signals, the men who tried to buy up all the gold in a city, and the government that quietly broke them in an afternoon. Some of it will surprise you. Some of it, if you have heard the market described as cold and mathematical, might surprise you more than that. It was built by people in a hurry, mostly improvising, and it still shows. A tree that no longer stands once decided how an entire country would come to buy and sell its fortunes. In May of 1792, 24 brokers gathered under its branches on a narrow street in Lower Manhattan and signed a single sheet of paper. That sheet outlived the tree by more than 2 centuries. Before the agreement, trading government bonds and bank shares in New York was a loose, half-formal business conducted at auctions and in coffeehouses, wherever a broker could find a buyer. Earlier that same year, a speculator named William Dorr had borrowed heavily to gamble on bank stocks and government debt, and when his schemes collapsed, he took a wide circle of lenders and investors down with him. The panic that followed was brief but sharp, and it left the city's brokers newly aware of how fragile trust could be when nobody agreed on how business ought to be conducted. 24 of them decided to fix that themselves, without waiting for any government to do it. Under a buttonwood tree, a kind of sycamore that grew along the street, they agreed to trade securities only among themselves, at a fixed minimum commission, and to give preference to each other over outside auctioneers, who might undercut the price. It was less a founding charter than a private club rule, written by men who wanted predictable partners more than they wanted new laws. That small, self-interested pact proved durable in a way none of the signers likely expected. The brokers who honoured it kept trading with each other through booms and failures alike, moving indoors within a few years and eventually adopting a formal constitution as the New York Stock Exchange. The commission structure they would agreed to under the tree lasted, in various forms, for nearly 200 years. Historians still debate how much credit the agreement itself deserves against the slower, messier process of an exchange finding its footing regardless, but the date and the tree remain the story New York tells about its own beginning. The tree is gone. The agreement in spirit still governs the block where it stood. In a print shop hidden inside a railroad office, a small crew worked through the night pressing out stock certificates as fast as the machine could run. Nobody outside that room knew how many shares of the Erie Railroad now existed, least of all the men trying to buy control of it. The Erie Railroad War, fought in the late 1860s, pitted the financier Cornelius Vanderbilt against a trio of Erie insiders led by J. Gould and Jim Fisk. Vanderbilt had been quietly buying Erie stock to add the line to his railroad empire, and Gould's faction, controlling the company's board, responded the only way they could think to stop him. They printed more shares. Corporate law at the time gave a company's directors real latitude to issue new stock, and Gould exploited that latitude with something close to glee, flooding the market with paper faster than Vanderbilt's brokers could absorb it. When a friendly judge ordered the new shares invalidated, Gould's faction simply found another judge, in another county, willing to rule the opposite way. For a while, New York effectively had 2 competing court orders about who owned the Erie Railroad, and neither side much cared which was more legitimate. When the pressure grew too great, Gould, Fisk and their allies famously fled across the Hudson River to Jersey City, with a trunk containing millions of dollars in cash and the company's most important records safely outside the reach of the New York courts that wanted to arrest them. From a hotel there, they kept running the railroad and negotiating their position, eventually settling with Vanderbilt on terms that let everyone involved walk away with something. Nobody went to prison. The episode became a kind of public education in how thin the rules governing corporate ownership still were, and it pushed lawmakers, slowly and imperfectly, toward tightening them. The railroad kept running the whole time, indifferent to who technically owned it. For one long week in September of 1869, the price of gold in New York climbed by the hour, and men who had never touched a bar of it in their lives found themselves owing sums they could not possibly pay. Jay Gould and Jim Fisk, fresh from their railroad battles, set their sights on something larger, the entire supply of gold available for trading in New York City. Their theory was simple enough to explain and devastating if it worked. If they could buy up nearly all the gold that traders had agreed to deliver on future contracts, then anyone who had sold gold short, promising to hand it over later at Today's price, would have nowhere to buy it except from Gould and Fisk themselves at whatever price they chose to name. To keep the government from releasing its own gold reserves and spoiling the plan, Fisk cultivated a friendship with President Ulysses Grant's brother-in-law, hoping for advance warning of any Treasury move. For a few days it worked precisely as intended. Gold prices leapt upward inside the trading room known as the Gold Room, and panic spread through anyone who had bet the price would stay stable. What broke the corner was the same government the schemers had tried to read in advance. On Friday, September 24, word reached Washington that the scheme was distorting the entire currency market, and the Treasury ordered the sale of several $1 million of government gold onto the open market. The price collapsed within minutes. Brokers who had been buying gold at inflated prices on Gould and Fisk's behalf were left holding contracts nobody could now afford, and the day became known as Black Friday, a name that would echo unrelated through later panics. Gould, characteristically, had quietly begun selling his own gold just before the price fell, walking away wealthier than when the scheme began, while men who had trusted his lead were ruined. The gold went back to trading at an ordinary price, and Gould went back to looking for the next opening. Long before anyone traded a share of anything there, Wall Street was, quite literally, a wall. In 1653, Dutch colonists governing what was then called New Amsterdam built a wooden defensive palisade across the northern edge of their small settlement on the tip of Manhattan Island, meant to guard against attack from English colonies and native nations alike. The wall ran roughly where the street of the same name runs today, and for a few decades it marked the literal edge of the city, the line beyond which the colonists judged it unsafe to build. Guards were posted along it, and residents were required by law to help maintain its upkeep, a civic duty enforced with fines for anyone who let their section fall into disrepair. It was never tested by the siege it was built for. The city's ownership changed hands from Dutch to English in 1664 without a shot fired at the wall itself. Once the immediate danger passed, the wall's usefulness faded quickly, and city authorities dismantled it by the early 1690s, its timber sold off and repurposed the way most obsolete fortifications were in a growing town that needed lumber more than ramparts. What remained was simply the road that had run alongside it, which kept the name long after the structure it described had vanished. Over the following century, as New York grew into a genuine commercial port, that road happened to be where merchants and brokers gathered to do business, close to the harbour and the old city hall. By the time the Buttonwood brokers signed their agreement in 1792, nobody building a financial district was thinking about defence at all, but the name stuck regardless, carried forward by simple habit rather than any deliberate choice. The wall kept nothing out for more than a generation. The name it left behind has kept nearly everything in. Before there was any building built for the purpose, New York's financial district was, functionally, a room full of coffee cups. In the years after the American Revolution, brokers dealing in government bonds, bank shares, and marine insurance policies had no dedicated exchange to work from, so they did what merchants in London and Amsterdam had already been doing for a century. They conducted business inside coffee houses. The T.H.N. Coffee House, opened in 1793 near the corner of Wall and Water Streets, quickly became the preferred gathering place for New York's trading community, its main room doubling as an informal auction floor most mornings. The building took its name from a tontine, an old and now largely abandoned financial arrangement in which a group of investors pooled money into a shared fund, with each survivor's share growing as other members died, until the last living member collected whatever remained. The coffee house itself was financed that way, its shares held by investors betting, in effect, on their own longevity. Inside, brokers shouted bids and offers across crowded tables, kept informal tallies, and settled trades on the strength of a spoken word and a familiar face rather than any written contract most days. There was no membership list, no fixed hours beyond when the coffee house happened to be open, and no rulebook beyond whatever social pressure kept regulars honest with each other. It was noisy, informal, and by most accounts thoroughly functional for the modest scale of trading New York did at the time. As the Buttonwood Agreement's signers, organised more formally through the 1790s and early 1800s, their meetings gradually shifted from the coffeehouse's main room to dedicated rented spaces, a slow move indoors that mirrored the exchanges, slow move toward becoming an institution rather than a habit. The coffee is long gone. The corner where the THN teen stood is still, roughly, where the district begins. For decades, knowing a stock's price meant standing close enough to hear someone shout it. Then a machine learned to print numbers onto a moving strip of paper, and distance stopped being an obstacle to trading. Before the stock ticker, brokers away from the exchange floor relied on runners, men who physically carried price quotations from the trading floor to nearby offices, a system that was fast enough for a single city block and useless for anywhere farther. The ticker, refined and popularized in the late 1860s by inventors including a young Thomas Edison, changed that by using telegraph technology to transmit prices automatically to a printing device that punched out letters and numbers onto a narrow paper tape, hence its name. A broker's office could now display prices that were, within a few minutes, accurate reflections of what was happening on the exchange floor across town, without a single runner involved. The device made a distinctive clicking sound as it worked, a sound so associated with trading that it lent its name to an entire genre of financial reporting long after the physical machines disappeared. What the ticker really dissolved was the advantage of simply being present. Before it, a broker standing on the floor knew things a broker in a distant office could only guess at, sometimes for hours. After it, that gap shrank to minutes, and eventually, as the technology spread and improved it, to seconds. Brokerages in cities far from New York could open offices that displayed live tape, letting clients anywhere along the wire follow prices almost as they happened. It reshaped who could plausibly participate in the market at all, turning trading from something that required physical proximity to something that mainly required a subscription and a machine. The tape stopped printing decades ago. The habit of watching a scrolling strip of numbers never really left. Long before anyone used the words to describe a market, English speakers were using them to describe the two most reliable ways to lose a bet. The terms bull and bear, applied to rising and falling markets, likely predate organised stock exchanges altogether, drawn from older trading slang in London that circulated well before the 18th century. One common explanation traces bear to an old expression, selling the bearskin before you have caught the bear, describing a trader who agreed to sell something he did not yet own, gambling that its price would fall so he could buy it cheaply before he had to deliver it. That kind of trader was called a bearskin jobber, later shortened simply to bear, and the term settled onto anyone betting that prices would decline. Bull's origin is less settled among historians, but the two words were paired early on for the way each animal is imagined to attack. A bull thrusts upward with its horns, a bear swipes downward with its paw, a tidy piece of folk symmetry that made the words easy to remember even for people with no interest in finance. By the time the South Sea bubble convulsed London's markets in 1720, both terms were already in wide enough use that pamphleteers and satirists used them freely, assuming their readers would understand without explanation. The language crossed the Atlantic along with the trading practices it described, arriving in New York's early markets fully formed rather than invented fresh. What is notable is how little the meaning has drifted in 3 centuries. A bull market still means rising confidence, a bear market still means falling prices, and both words still carry a faint trace of their original sense of an animal, and a trader committed fully to one direction. Nobody remembers who coined either word. Everybody who trades still uses both. In the 1830s, a traveller crossing several states might carry a stack of paper bills issued by a dozen different banks, each one worth a different amount, depending on how far it had travelled from the bank that printed it. The reason was simple and, in retrospect, alarming. Hundreds of state-chartered banks across the country issued their own paper currency, redeemable in gold or silver on demand. but many held nowhere near enough of either to actually honour that promise if too many people asked at once. Some of the flimsiest of these institutions earned the nickname Wildcat banks, reportedly because a few were said to be located in such remote, sparsely populated places that only wildcats would ever visit to demand payment, making it easy for the bank to print money nobody could easily redeem. A speculative boom in Western land, financed heavily by this loosely backed paper, sent prices climbing through the mid-1830s, encouraged in part by federal policy that had scattered government deposits across many of these same state banks, rather than concentrating them in one stable institution. The collapse, when it came in 1837, arrived with brutal speed. A tightening of credit in Britain reduced the flow of capital into American markets, land prices buckled, and a wave of bank runs spread from state to state as depositors who had trusted paper currency for years suddenly wanted metal instead. Banks that could not produce the gold and silver they had promised simply suspended payments, leaving their notes worth whatever the next person was willing to accept for them, which in many cases was very little. The depression that followed lasted the better part of 6 years in some regions, a slow unwinding of a boom that had been built on promises far thinner than anyone wanted to examine while prices were still rising. The wildcat banks disappeared. The habit of trusting paper promises a little too easily did not. A woman in a worn black dress walked into a bank during one of the country's worst panics, carrying enough cash to save it, and the newspapers of the day found her thrift more interesting than her generosity. Hetty Green, born into a wealthy New England whaling and shipping family in 1834, learned to read financial newspapers to her father as a child, and by adulthood she managed her own inherited fortune with a discipline that unsettled people who expected a wealthy woman to spend more visibly. She invested heavily and carefully in railroad bonds, real estate, and government securities, avoiding the more speculative corners of the market that ruined many of her male contemporaries. During several financial panics, including the one in 1907, cities and even the state of New York itself came to her directly for short-term loans when banks were too strained to lend, and she reportedly obliged at reasonable terms, quietly propping up institutions that some of Wall Street's grander names would not touch. By the time of her death in 1916, she was widely considered the richest woman in the United States. Her fortune built almost entirely through patient lending and careful accumulation rather than any single dramatic trade. What the public seized on instead was her frugality, often exaggerated into caricature by newspapers that nicknamed her the Witch of Wall Street for her plain black clothing and her reputation for haggling over small expenses despite her enormous wealth. Some of the stories told about her, including claims about refusing medical treatment for her son to save money, are disputed by biographers who note how thin the sourcing is behind the most colourful anecdotes. What is well documented is simpler, and, in its way, more interesting. A woman who understood risk better than most of the men lending beside her, and who was remembered less for that skill than for how she dressed while exercising it. Her money outlived the caricature outlived her by more than a century. One banking house's failure in Philadelphia closed the entire New York Stock Exchange for 10 straight days, an event with no real precedent in the exchange's 80-year history. The banking house belonged to J. Cook, a financier who had made his name selling government bonds during the Civil War and had since poured enormous sums into building the Northern Pacific Railroad, one of several rail lines racing to connect the country's interior to its coasts. American railroads had been overbuilt for years by the early 1870s, financed largely through bonds sold to European investors who had grown enthusiastic about the country's seemingly limitless expansion. When a financial crisis in Vienna rattled European confidence in 1873, that flow of capital slowed sharply, and Cook's firm, overextended and unable to sell enough Northern Pacific bonds to cover its obligations, collapsed within days. The failure of a firm as respected as Cook's shattered confidence across the entire financial system, and the New York Stock Exchange, faced with a wave of panic selling it judged unmanageable, simply shut its doors rather than let trading continue. What followed was less a single dramatic crash than a long grinding depression that stretched, by many accounts, into the early 1880s in some sectors. Dozens of railroads defaulted on their bonds, construction projects across the country halted mid-completion, and unemployment rose sharply in industrial cities that depended on rail-related manufacturing. The episode became one of the first clear American demonstrations that a financial failure thousands of miles from Wall Street, an interest rate shift in Vienna, could ripple through American railroad bonds and land straight on New York's own trading floor within weeks. The exchange reopened after 10 days. The railroads it had financed took years longer to recover. The idea behind a market corner is almost embarrassingly simple to explain, which is part of why it kept tempting ambitious men who should have known better. A corner begins with an ordinary feature of many markets. Traders sometimes agree to sell something, a commodity, a stock, a bushel of grain, at today's price, with delivery promised at some future date, even if they do not actually own that thing yet. They are betting the price will fall or stay steady before delivery comes due, at which point they can buy cheaply and hand it over at a profit. This kind of promise is called selling short, and it works fine as long as enough of the actual good exists to be bought when the time comes. A corner happens when someone quietly buys up so much of the available supply that the short sellers, when their delivery date arrives, discover there simply is not enough left in the market to buy at any reasonable price except from the person who now controls the supply. At that point, the cornerer can name almost any price, because the short sellers have no alternative but to pay it or default entirely. The trouble, historically, is that corners are unstable by nature. Holding enough of a commodity or stock to control its price usually requires enormous borrowed capital, and the squeezed party or outraged regulators frequently find some way to break the corner before the cornerer can safely sell out of the position at a profit, exactly as happened to the Gould scheme of 1869. Exchanges eventually wrote explicit rules against cornering specific markets, and regulators gained the power to intervene directly, as the Treasury did that same year, releasing supply to break an artificial scarcity before it could be fully exploited. The tactic never entirely vanished, but it became progressively harder to execute as markets grew larger and better policed. A corner promises control. It rarely lasts long enough to enjoy it. On Broad Street, outside the New York Stock Exchange's own building, a second market ran for decades with no roof, no chairs, and no formal membership at all. Brokers who dealt in smaller or newer companies, ones not yet established or wealthy enough to secure a coveted seat on the main exchange, simply traded outdoors on the curb near the exchange building, a practice that dated back to the 19th century and continued well into the 20th. These curb brokers developed their own elaborate system for staying in touch with clerks, positioned in the windows of nearby office buildings, who relayed buy and sell orders down to the street using hand signals and coloured clothing that could be read from several stories up over the noise of traffic and shouting brokers below. A single curb broker might be watching 4 or 5 windows at once, tracking silent instructions in a kind of coded semaphore that outsiders found bewildering and insiders found perfectly ordinary. The outdoor market persisted through New York winters and summers alike, an odd, hardy institution that traded genuine securities worth real money while its participants stood in the street getting rained on. It was not until 1921 that the curb market finally moved indoors into a permanent building of its own, adopting rules and a membership structure that gradually made it resemble the formal exchange it had traded beside for so long. In 1953 it renamed itself the American Stock Exchange, shedding the last obvious trace of its outdoor origins, though the hand signal system it had perfected in the street lingered on inside the new building's own trading floor for years afterward, a habit too useful to abandon just because a roof had finally arrived. The street outside the exchange grew quiet. The market it had hosted simply moved indoors and kept going. A customer could walk into a storefront near any American city's business district, hand over a small sum, and bet on whether a stock's price would rise or fall, without a single share ever changing hands. That storefront was called a bucket shop, an establishment that displayed live stock and commodity prices, usually via ticker tape piped in from a real exchange, and let customers place what amounted to wagers on those prices without the shop actually executing any trade on their behalf. If a customer bet that a stock would rise and it did, the shop paid out. If it fell, the shop kept the customer's stake. No real order was placed anywhere, no real ownership changed hands, and the shop itself profited most reliably from the house edge built into the terms, much like a casino running a game rather than a broker executing a client's instructions. The name likely came from the practice of literally keeping the day's wagered cash in a bucket behind the counter, though the exact origin is debated among historians of the practice. bucket shops thrived especially in the decades around the turn of the 20th century, offering ordinary people with modest savings a cheap, informal way to gamble on market movements without the fees or minimums a real brokerage required. Legitimate exchanges despised them, both for the reputational damage of being associated with what was essentially unlicensed gambling, and because bucket shops depended on piped-in real prices without paying the exchanges that generated them. A combination of state anti-gambling statutes, federal securities laws passed in the 1930s, and coordinated pressure from exchanges to cut off their price feeds eventually forced most bucket shops out of business by the mid-20th century. The storefronts closed one by one. The appetite they would been feeding simply found other outlets. In a private library on East 36th Street, the most powerful bankers in New York sat through the night in 1907, unable to leave until one elderly financier decided they could. The panic had begun with a failed attempt to corner the stock of a copper company, which triggered a run on the trust companies that had financed the scheme, institutions that operated much like banks, but with far lighter regulatory oversight at the time. As trust after trust faced lines of depositors demanding their money, the crisis threatened to spread into the banking system proper, and with no central bank in the United States to act as a lender of last resort, the job fell, almost by default, to J.P. Morgan, then in his 70s and the most respected financier in the country. Morgan personally reviewed the books of failing institutions late into the night, deciding which were salvageable and which were not, and summoned the city's leading bankers to his library, reportedly locking the doors at one point until they agreed to jointly pledge millions of dollars toward a rescue fund. It worked, largely because the market believed it would, and confidence in the trust company stabilized within days, once word spread that Morgan himself was standing behind them. The rescue's success was also its most unsettling feature. The country had just watched its financial system survive only because one private citizen happened to have both the fortune and the personal authority to organize a bailout on his own initiative, with no formal mechanism guaranteeing anyone would step up the next time. That discomfort became one of the central arguments for creating a permanent institution to manage exactly this kind of crisis, and it fed directly into the debates that produced the Federal Reserve Act in 1913, establishing a central bank explicitly so the country would never again depend on the goodwill of a single banker in a locked library. Morgan's signature ended the panic. The law that followed made sure no signature would need to again. The number that financial reporters have quoted every trading day for more than a century began as one journalist's attempt to make sense of a stack of newspaper clippings. Charles Z. Doe, a financial reporter who co-founded the Wall Street Journal, reasoned in the 1890s that tracking the combined stock prices of a handful of major companies would give a rough but useful sense of the overall market's direction, sparing readers the impossible task of following every listed stock individually. In 1896, he settled on 12 industrial companies, averaging their share prices into a single daily figure that became known as the Dow Jones Industrial Average, named for Dow and his business partner Edward Johns. Almost none of the original 12 companies survive under those names today. Several were absorbed into other firms, some dissolved outright, and the list of companies making up the average has been swapped out repeatedly over the decades as industries rose and fell, so that the number itself has always tracked American business broadly, while its specific ingredients kept changing underneath it. Dow never claimed his average was a precise measurement of anything. He saw it as a simplified signal, a way to spot broad trends without drowning in detail, and he developed a set of observations about how the average's movements related to overall market psychology that later analysts formalized into what is called Dow theory. The average expanded from 12 companies to 20 in 1916 and to 30 by 1928, a size it has kept ever since, even as it remains, mathematically, a far cruder instrument than most people assume when they hear its number quoted on the evening news. It was never meant to be exhaustive, it was meant to be quick. The 12 companies are gone. The habit of quoting their average never really stopped. For most of the 20th century, if you wanted to trade a particular stock on the New York Stock Exchange, there was exactly one place on the floor you had to go, and exactly one person standing there who mattered. Each listed stock was assigned to a specific location on the trading floor called a post, and a designated specialist stood there for the entire session, responsible for managing the flow of buy and sell orders for that stock and no other. The specialist kept a private ledger, known simply as the book, recording every order that had not yet been matched with a counterparty, a record no other broker was allowed to see directly. This gave the specialist a genuinely privileged view of supply and demand for that one stock, and with it came an obligation the exchange took seriously. Specialists were required to maintain what was called a fair and orderly market, which, in practice, meant they sometimes had to buy or sell from their own account, at a loss if necessary, simply to keep prices from swinging too violently when buyers or sellers temporarily vanished. The system rewarded specialists handsomely in calm markets, where their privileged position let them profit steadily from the small gap between buying and selling prices. But it also placed real responsibility on them during panics, when maintaining an orderly market could mean absorbing losses no one else on the floor was willing to take. Critics argued for decades that the arrangement gave specialists an unfair informational edge over ordinary traders, while defenders pointed to episodes, including parts of the 1987 crash, where specialists' willingness to keep buying arguably prevented worse outcomes. As electronic trading matured through the 1990s and 2000s, the specialist system was gradually phased out in favor of automated matching engines that needed no single human standing at a post at all. The posts are still there on the floor. Almost nobody stands at them the old way anymore. A brass bell not much larger than the kind that once hung outside a country schoolhouse has decided when an entire trading day begins since the 1870s. Before any bell existed, the exchange floor simply grew noisy at some point each morning, as enough brokers arrived and began shouting orders, an informal and gradually creeping start time that made it hard for anyone to know precisely when trading had officially begun. The exchange introduced a gong and later a bell specifically to solve this problem, giving the entire floor a single, unambiguous signal that cut through the general noise and marked the exact start and end of the trading session. For decades, this was its whole function, a practical tool for busy people who needed a clear marker, nothing more ceremonial than a factory whistle or a church clock. The bell's role slowly changed as the exchange became more comfortable with public attention. By the mid-20th century, the exchange occasionally invited notable visitors to press the button that triggered it, and by the final decades of the century, this had become a formal daily ritual, with companies, celebrities, and public figures actively competing for the privilege of ringing in a session, often tied to a company's stock going public or some milestone worth marking. Television cameras began covering the moment regularly, turning what had been an internal signal for floor traders into a small piece of public theatre broadcast to anyone watching financial news. The bell itself changed little in size or design across all of this. What changed was everything around it, an entire industry of ceremony built on top of a device that had originally existed purely to tell tired brokers it was time to start or stop. The bell still rings for the same reason it always did. Almost everything else about the moment is new. A membership on the New York Stock Exchange was, for most of its history, called a seat. Even though nobody who held one was guaranteed anywhere to sit, the exchange fixed the total number of these memberships at 100 in 1953, a limit that had crept toward that figure gradually over the preceding decades, and it stayed exactly there for the rest of the century. Owning a seat was the only way an individual could trade directly on the floor, and because the supply was permanently capped, a seat behaved like any other scarce asset. Its price rose when trading was brisk and profitable, and it fell hard when the industry itself was struggling. In the depths of the Great Depression, a seat could be bought for a few $1,000s, a price that reflected just how little anyone believed trading itself was worth defending at the time. Decades later, during more prosperous periods, the same seat changed hands for well over $1 million, purely because the right to stand on that particular floor had become that valuable to firms competing for direct access. Seat owners could lease their membership to someone else, if they did not want to trade personally, creating a small secondary market in seat rentals alongside the market for outright ownership, and firms often held multiple seats under different employees' names to maintain a floor presence across departments. The whole arrangement depended on the assumption that physical presence on the trading floor was essential to executing trades well, an assumption that held for nearly 2 centuries and then eroded rapidly Once electronic trading systems could match buyers and sellers without anyone standing anywhere in particular. When the exchange itself went public in 2006, it converted the old seats into a different kind of license entirely, formally ending the seat system that had defined floor access since long before anyone alive had been born. The seats no longer exist as objects to be bought and sold. The floor they once guaranteed access to is quieter than it has ever been. A single stock became so associated with speculative fever in the late 1920s that its ticker symbol alone was enough to start a conversation in any barbershop or elevator in New York. The Radio Corporation of America, known widely simply as RCA, sold something genuinely new and exciting. Consumer radio technology at a moment when the medium was transforming daily life for millions of Americans almost overnight. That real technological promise made RCA a favorite target for speculative buying, as investors reasoned, not unreasonably at first, that a company at the center of such a fast-growing industry deserved a rapidly rising price. But the buying quickly outran anything the company's actual earnings could support, driven less by careful analysis of RCA's radio business, and more by the simple observation that the stock had been rising and seemed likely to keep rising, a self-reinforcing loop that drew in buyers who knew little about the company beyond its ticker symbol and its reputation. RCA never paid a dividend during this entire period, meaning shareholders' only possible return was a rising share price, which made the stock in effect a pure bet on continued enthusiasm rather than on any income the underlying business generated. When the broader market turned in October of 1929, RCA fell with a severity that matched how far speculative buying had carried it above any level its earnings could justify. Investors who had bought near the peak, often on margin, watched a stock that had seemed like the clearest bet on the future collapse to a small fraction of its former price within weeks. The company itself survived the crash intact, its radio business continuing to grow through the 1930s regardless of what its stock had done, a distinction that got lost for a long time in how thoroughly the shares themselves had become a symbol of the crash's excess. The technology RCA sold kept getting better. The mania around its stock never really returned in quite the same form. In the years before 1929, it was possible to buy $100 of stock while putting down only 10, and thousands of ordinary investors did exactly that without fully understanding what they had agreed to. Buying on margin meant a brokerage would lend an investor most of the purchase price of a stock, holding the shares themselves as collateral for the loan and charging interest on the borrowed portion. As long as the stock's price rose, this arrangement magnified gains impressively. A small rise in the stock's price represented a much larger percentage gain on the small amount of cash the investor had actually put down. The danger sat on the other side of that same arithmetic. If the stock's price fell far enough, the value of the collateral backing the loan dropped below what the brokerage required to feel secure, triggering what was called a margin call, a demand that the investor immediately deposit more cash or have the shares sold automatically to repay the loan. Because so many investors across the market were leveraged this way simultaneously by the autumn of 1929, a moderate initial price decline was enough to trigger a wave of margin calls all at once. Each forced sale added new selling pressure to a market that was already falling, pushing prices down further and triggering yet another round of margin calls among investors who had bought at slightly higher prices, a mechanical chain reaction that had little to do with the underlying value of the companies involved. Brokerages themselves had borrowed heavily to fund these loans to customers, meaning the same chain reaction threatened the brokerage's own solvency as their collateral shrank. It was this leverage, more than any single piece of bad news, that turned an ordinary market correction into something that fed on itself for days, each forced sale creating the conditions for the next one. The stocks eventually found a floor. The debt that had amplified the fall took years to unwind. By mid-morning on October 24, 1929, the ticker tape was running so far behind actual trading that brokers on the floor of the New York Stock Exchange had no reliable way to know what prices actually were. Selling had begun building for days before, but on this particular Thursday it accelerated into something closer to a stampede, as margin calls forced sale after sale onto a floor that was already struggling to absorb the volume. Reports from the visitors' gallery that morning described scenes of open panic among traders normally known for composure, some reportedly in tears as they watched holdings they had believed secure evaporate in value within a single session. Word of the chaos spread quickly to crowds, gathering outside the Exchange Building on Broad Street, adding a layer of public spectacle to what was, on the floor itself, a genuinely desperate scramble to execute orders that kept arriving faster than anyone could process them. Sometime around midday, a group of the city's leading bankers, organized in a manner that consciously echoed J.P. Morgan's intervention during the 1907 panic, though this time led by his son and successor, along with several other major bank heads, pooled a substantial sum of their own institution's money and directed it toward buying stock on the floor, hoping to signal to the market that confidence had returned from the top. The gesture worked, briefly and dramatically. Prices stabilized and even recovered somewhat for the remainder of the session, and newspapers the following morning described the crisis as essentially resolved. That calm lasted only through the weekend. When trading resumed the following Monday, selling returned with even greater force, and by Tuesday the market had fallen further than the bankers' pool could plausibly counteract a second time. The intervention brought a single afternoon of calm. The crash it was meant to stop had barely begun. Joseph Kennedy later claimed the moment he decided to sell out of the stock market entirely came from an unlikely source, a boy shining his shoes on a New York street corner. According to the story as Kennedy told it himself in later years, the Shoeshine boy, while working on his customers' shoes, offered Kennedy an unsolicited stock tip, confidently naming which shares he expected to rise. Kennedy, a wealthy and experienced investor who had made and remade fortunes across several industries, reportedly took this small moment as a signal that the market's enthusiasm had spread so far beyond people with any real financial knowledge that a serious downturn had to be coming. He began selling his own substantial stock holdings shortly afterward, in 1929, before the crash arrived, and the story of the Shoeshine boy became in the decades since one of the most frequently repeated anecdotes about that entire period, cited as an example of contrarian instinct rewarded. Historians examining Kennedy's actual finances have noted that the anecdote, whatever its literal accuracy, fits a broader and better documented pattern. Kennedy did substantially reduce his market exposure before the crash, whether prompted by a Shoeshine boy specifically, or by his own more general reading of a market that had grown detached from anything resembling sober valuation. What makes the story worth telling, regardless of how much credit the Shoeshine boy personally deserves, is what it reveals about how far speculative fever had spread by 1929, reaching workers with no formal financial training, who nonetheless felt confident offering stock tips to wealthy customers, a sign, in hindsight, that market participation had grown far wider and shallower than the fundamentals underneath it could support. The boy's name was never recorded. Kennedy's fortune survived the crash largely intact. A quiet attorney from New York spent months questioning some of the most powerful bankers in the country under oath, and by the time he'd finished, the public's picture of Wall Street had permanently changed. Ferdinand Pecora, appointed chief counsel to a Senate committee investigating the causes of the 1929 crash, began his harsher questioning in early 1933, and quickly moved well beyond the committee's original modest scope. His methodical, unhurried style of questioning drew out admissions that shocked even seasoned observers. Bank executives had sold securities to their own customers that they privately knew to be weak, had manipulated stock prices through coordinated pools of insider trading, and had in some cases paid themselves substantial bonuses while their institutions failed and depositors lost savings. National City Bank's chairman testified that he had paid no income tax at all in a recent year through legal but aggressive maneuvering, a detail that landed particularly hard on a public still reeling from years of Depression-era hardship. The hearings, extensively covered in newspapers, turned abstract financial misconduct into vivid, specific stories that ordinary Americans could follow and feel genuinely angry about. That public anger became one of the clearest political forces behind the Securities Act of 1933 and the Securities Exchange Act of 1934, the two laws that established meaningful federal oversight of stock offerings and trading practices for the first time, and created the Securities and Exchange Commission to enforce them. President Franklin Roosevelt, notably, chose Joseph Kennedy, the same investor whose Shoeshine boy story is often told about 1929, as the new commission's first chairman, reasoning that someone who had thoroughly understood the market's old tricks would be best positioned to police them. The Pecora hearings themselves produced no criminal convictions, but the legal architecture they inspired reshaped how American markets operated for the rest of the century. The bankers Pecora questioned mostly kept their positions. The rules that governed everyone after them were never the same. A single law passed in 1933 forced American banks to choose an identity. They could take ordinary deposits, or they could underwrite and sell securities, but a single institution could no longer easily do both. The Banking Act of 1933, popularly known by the names of its two chief sponsors, Senator Carter Glass and Representative Henry Steagall, responded directly to accusations, many aired that same year in the Pecora hearings, that commercial banks had used depositors' money to underwrite risky securities, and then pressured the same depositors into buying those securities, creating a dangerous conflict of interest that had helped inflate the speculative bubble of the late 1920s. By requiring banks to separate their deposit-taking business from their securities business into legally distinct entities, lawmakers hoped to remove that conflict entirely, letting each kind of institution focus on its own function without one activity's risks endangering the other. The law also established federal deposit insurance for the first time, guaranteeing ordinary depositors that their savings would be protected even if their bank failed, a separate but related response to the wave of bank runs that had devastated communities earlier in the Depression. The separation held for more than 6 decades, shaping the basic structure of American finance into 2 distinct tracks: commercial banks that took deposits and made loans, and investment banks that underwrote and traded securities, each operating under different rules and different regulators. Over time, as financial markets grew more complex and international competitors operated under no such restriction, pressure built steadily to loosen the wall between the 2 kinds of institutions, and successive rulings and legislative changes gradually eroded it before Congress formally repealed the core separation in 1999. Economists and historians still debate, without full agreement, how much the original law actually prevented and how much its later repeal contributed to subsequent financial instability, a debate that remains genuinely open rather than settled in either direction. The wall the law built stood for 2 generations. What replaced it is still being argued over. In the late 1960s, some of Wall Street's oldest and most respected firms were brought to the edge of collapse not by bad trades, but by paper. Trading volume on the New York Stock Exchange had grown rapidly through the decade as more Americans invested in stocks, and every one of those trades still required physical settlement. A paper certificate representing the shares had to be located, verified, and physically transferred between the selling firm and the buying firm's offices, all handled by clerks working with actual documents rather than any electronic record. Back offices, the unglamorous departments responsible for this settlement work, had not grown their staffing or their systems to match the surge in volume, and by 1968 the backlog of unprocessed trades at many firms had grown to alarming proportions, certificates piling up faster than clerks could file, verify, and deliver them. The exchange took the extraordinary step of closing trading entirely on Wednesdays for several months, giving back offices an extra day each week just to work through the accumulated paperwork, a solution that would have sounded absurd to anyone describing modern financial markets a generation earlier or later. Even with the shortened trading week, some firms simply could not recover. The volume of lost, misfiled, or improperly transferred certificates had grown so large that several well-established brokerages failed outright in what became known within the industry as the paperwork crisis, unable to reconcile their own records well enough to know their true financial position. The crisis became one of the clearest arguments for moving stock ownership away from physical certificates entirely and toward electronic record-keeping, a shift that accelerated through the 1970s as the industry built the centralized depository systems that would eventually make paper certificates largely obsolete. The backlog eventually cleared. The paper it was made of never fully came back. Stock certificate, in the era before electronic ownership, was often a genuinely beautiful object, engraved with intricate borders and allegorical figures that had nothing to do with the company's business and everything to do with stopping forgers. The elaborate engraving found on old stock certificates served a real security function, much like the ornate design on paper currency. The more detailed and difficult a design was to reproduce by hand, the harder it was for a counterfeiter to fake a convincing certificate. Owning stock meant physically holding one of these documents, often kept in a safe deposit box, and transferring ownership meant physically endorsing the certificate and delivering it to a new owner, or a brokerage acting on their behalf. A process the paperwork crisis of the late 1960s had shown could buckle under enough trading volume. Losing a certificate could mean a genuinely difficult process to prove ownership and obtain a replacement, and a certificate destroyed in a fire or flood represented a real, sometimes unrecoverable loss for its owner. The solution the industry built in response was a system called book entry ownership, administered through central depositories that maintained electronic records of who owned what, without any certificate changing physical hands at all in most transactions. The Depository Trust Company, established in the early 1970s, became the central institution holding vast numbers of certificates in bulk on behalf of brokerages, while individual investors' ownership was tracked electronically through their brokerage accounts, rather than through any physical document they personally held. By the final decades of the 20th century, most newly issued shares existed only as electronic entries, and physical certificates, while still technically available for investors who specifically requested them, had become a rare novelty rather than the standard form ownership took. The old certificates still turn up occasionally in attics and safe deposit boxes. What they represent now exists mostly as a number in a database. On a trading floor loud enough to make shouted words useless past a few feet, traders built an entire second language out of nothing but their hands. Open outcry trading, the dominant method on commodity and options exchanges for most of the 20th century, required traders standing in a crowded sunken area called a pit to communicate buy and sell orders to each other across noise that often made verbal communication unreliable beyond a short distance. The system of hand signals that developed to solve this problem followed fairly consistent conventions across many exchanges. Palms facing toward one's own body typically signaled a desire to buy, while palms facing outwards signaled a desire to sell, and the number of fingers held up, sometimes at the forehead for tens and above the forehead for higher increments, conveyed price or quantity information with a precision that a shout alone could not reliably achieve in a crowded room. A skilled trader could read another trader's entire proposed transaction, price, quantity and direction from across a pit in a fraction of a second, without either of them saying a word. What is notable is how long this system persisted even after telephones and later computer terminals were readily available on the same trading floors. Traders in many pits continued relying on hand signals well into the 1990s and beyond, not out of nostalgia, but because, for the specific task of communicating simple, urgent information across a short, crowded, noisy space, the hand signal system genuinely outperformed any electronic alternative available at the time. It took the more thorough shift to fully electronic trading, matching buyers and sellers through computer systems rather than any physical floor at all, to finally make the pit and its silent language mostly obsolete, though a handful of open outcry pits persisted in specialized markets even after most trading had migrated to screens. The shouting eventually stopped. For a long time before it did, nobody in the pit needed to hear a thing. A whole class of brokers on the New York Stock Exchange floor existed for one purpose only: helping other brokers who had taken on more business than they could personally handle. These independent floor brokers earned the nickname $2 brokers from an old, long-abandoned flat commission rate of $2 charged for executing a single order on behalf of another firm, a rate that stuck as a nickname long after the actual fee structure had changed many times over. A larger brokerage firm's own floor staff might be occupied executing several orders simultaneously during a busy session, unable to physically reach every post where a client's order needed to be placed. Rather than let that order wait, the firm would hand it off to an independent $2 broker, someone with no permanent employer among the major firms but a general seat, and standing to work anywhere on the floor, who would execute the trade at the appropriate post and collect a small fee for the service. These brokers effectively functioned as freelance overflow capacity for an entire floor's worth of larger firms, moving fluidly from one temporary assignment to the next throughout a trading day. The role required an unusual combination of skills. Enough standing and trust that other firms would hand over real client orders without hesitation, enough speed and floor knowledge to execute quickly at the right price, and enough independence to serve competing firms within the same session, without any conflict of interest becoming a problem. $2 brokers were, in effect, the floor's own informal labour market, matching temporary excess demand for execution with available capacity in real time, a role that required constant physical presence and quick judgment rather than any specialised product knowledge. As electronic order routing systems matured, the practical need for this kind of human overflow capacity diminished sharply, and the role, like the specialist system it worked alongside, largely disappeared from a floor that increasingly ran on software rather than foot traffic. The fee that gave them their name stopped applying generations before the job itself did. The nickname simply outlasted both. On October 19, 1987, the Dow Jones Industrial Average fell by a larger single-day percentage than it had on any day of the 1929 crash, and the market had no mechanism whatsoever to pause and let anyone catch their breath. The decline, which came to be known as Black Monday, unfolded with unusual speed even by the standards of previous crashes, driven in significant part by automated trading strategies that had grown popular through the mid-1980s. Chief among these was a strategy called portfolio insurance, which used computer models to automatically sell stock index futures as markets fell, intended to protect large institutional portfolios from losses. On October 19, so many institutions were running similar strategies simultaneously that their automated selling reinforced itself. Falling prices triggered more automated selling, which pushed prices down further, which triggered still more selling, all happening within minutes across systems that had never been tested under conditions this extreme. There was at the time no rule anywhere in the market structure that could interrupt this loop once it started. Trading simply continued at whatever price the selling pressure produced, all the way down. In the aftermath, regulators and exchanges concluded that the market genuinely needed some mechanism to force a pause during periods of extreme volatility, giving human judgment a chance to reassert itself over automated systems that had no capacity to recognize was making things dramatically worse. The result was the circuit breaker, a rule introduced in the years following the crash that automatically halts trading market-wide for a set period once prices fall past specific defined thresholds within a single session. The rule has been triggered only rarely in the decades since, but its existence represents a direct, traceable response to watching a market fall with no way to stop itself even for a moment. The crash lasted a single afternoon. The rule it produced has outlasted every market it was designed to protect since. The strategy that was supposed to protect large investors from a falling market instead became one of the clearest reasons the market fell as far as it did. Portfolio insurance, the computer-driven strategy widely adopted by pension funds and other large institutional investors through the mid-1980s, worked on a straightforward premise. As a stock portfolio's value declined, the strategy's models would automatically sell stock index futures contracts to offset further losses, effectively creating a synthetic form of downside protection without the institution needing to sell its actual underlying stock holdings. The strategy had performed reasonably well in smaller, more ordinary market declines, which gave institutions confidence to adopt it in large numbers, unaware that this widespread adoption itself was quietly creating a new and untested kind of risk. If enough institutions ran similar models simultaneously, their combined automated selling in the futures market could become large enough to influence the underlying stock market's own price, which in turn would trigger their models to sell even more, a feedback loop that none of the individual firms running the strategy had designed or intended, because none of them had modeled what would happen if everyone else was running the same program at the same moment. On October 19, 1987, that feedback loop activated in full, with automated selling in stock index futures dragging down futures prices, which in turn dragged down the underlying stocks those futures were meant to track, in a self-reinforcing spiral that human traders on the floor could see happening but had no practical way to stop. The episode became a foundational case study in a phenomenon regulators later took far more seriously, that a strategy which looks safe for a single institution acting alone can become dangerous once many institutions adopt something similar, because the collective effect is never simply the sum of each individual, isolated decision. Each institution believed it was protecting itself. Together, they built exactly the fall they were trying to avoid. A young bond trader convinced a generation of investors to buy debt from companies that established banks had refused even to consider lending to, and for a decade he was right often enough to build an empire on it. Michael Milken, working at the investment bank Drexel Burnham Lambert through the late 1970s and 1980s, built his career around a specific insight drawn from academic research he would studied as a student. That lower-rated corporate bonds, often called junk bonds because rating agencies judged their issuers a meaningfully higher risk of default, historically paid investors an interest rate generous enough to more than compensate for that added risk across a large enough portfolio of them. Milken used this insight to build a genuinely enormous market for high-yield debt, helping companies that traditional banks considered too risky raise large sums of money by issuing bonds directly to investors willing to accept the higher risk in exchange for higher interest payments. This new source of capital fueled, among other things, a wave of leveraged buyouts, transactions in which investors used heavily borrowed money, financed substantially by these junk bonds, to acquire entire companies, often planning to sell off pieces or cut costs to pay down the debt afterward. Milken's methods and his enormous personal earnings, at one point among the highest annual incomes ever reported by an individual on Wall Street, drew increasing scrutiny through the late 1980s, and in 1990 he pleaded guilty to securities fraud charges related to his trading activities, serving time in prison and paying substantial fines and restitution. The junk bond market he had built did not disappear along with his career. High-yield debt remains a permanent, if smaller and more conservatively regulated, part of how companies raise money, a lasting legacy of an insight that outlived the specific man and the specific decade most associated with popularizing it. The man who built the market went to prison. The market itself simply kept trading without him. A single investor, sometimes acting almost entirely alone, could accumulate a large enough stake in a major American company during the 1980s to force its own management into a fight for survival. Corporate raiders, as they became widely known through the decade, followed a fairly consistent playbook. Identify a company whose stock price seemed low relative to the value of its underlying assets or businesses, quietly buy a substantial minority stake, and then publicly propose changes, sometimes a full acquisition, sometimes a restructuring, sometimes simply demanding a board seat that current management strongly opposed. Because the raider often had no need for the target company's full cooperation, financing much of the purchase through the same junk bond markets that Milken had helped build, these campaigns became known as hostile takeovers, contested directly with the sitting board rather than negotiated cooperatively. Target companies developed their own countermeasures in response, most famously the poison pill, a defensive maneuver that automatically flooded the market with new shares if a hostile buyer's stake crossed a certain threshold, diluting the raider's position and making a full takeover prohibitively expensive. The battles that resulted played out in public with genuine drama, full of tender offers, lawsuits, proxy fights, and sometimes a rival bidder called a white knight, brought in by management specifically to outbid the raider on friendlier terms. Supporters of the raiders argued they were performing a useful function, forcing complacent management teams to run their companies more efficiently or hand control to someone who would. Critics argued the wave of hostile activity prioritized short-term stock gains over the long-term health of the businesses and the workers inside them, a debate that has never fully resolved one way or the other. The decade left a permanent mark on how corporate boards operated, making takeover defense planning a routine part of running any publicly traded company from that point forward. The raiders mostly moved on to other targets eventually. The defenses companies built against them never really came down. For much of the 20th century, thousands of publicly traded American companies never appeared on any exchange floor at all, quoted instead on literal sheets of pink paper distributed among dealers. Companies too small, too new, or too obscure to meet the listing requirements of the major exchanges still needed some way for their shares to trade, and the solution that developed was a decentralized system called the over-the-counter market, in which individual dealers, operating from their own offices rather than any central trading floor, agreed to buy and sell specific stocks directly from and to each other and to customers. The National Quotation Bureau began printing daily price lists for these stocks on distinctively colored pink paper starting in the 1900s, a simple visual shorthand that gave the entire system its enduring nickname. The pink sheets, even long after the actual color had stopped mattering practically. A dealer willing to trade a given stock was called a market maker for that stock, quoting a price at which they would buy and a slightly higher price at which they would sell, profiting from that small spread rather than from any exchange listing fee. The pink sheets carried a certain reputation, often deserved, as a market where fraud and manipulation were harder to police than on a regulated exchange, since listing standards, financial disclosure requirements, and oversight were all considerably lighter than what companies faced to secure a spot on the New York Stock Exchange. Legitimate small companies traded there too, simply because they had not yet grown large enough to qualify for a major listing, alongside companies that had been delisted from bigger exchanges for failing to meet ongoing requirements. The pink paper itself disappeared decades ago, replaced by an electronic quotation system that still, informally, carries the old name, a case where the technology changed completely, while the nickname simply refused to update. The paper stopped being printed long ago. The name it left behind never really updated to match. A state banking official in Kansas, fed up with promoters selling stock in schemes with nothing real behind them, reportedly said some of these companies had no more substance backing their shares than the blue sky overhead. That complaint, whether or not the exact wording is precisely as legend records it, captured a genuine problem plaguing early 20th century America. Traveling promoters roamed the country selling shares in mining ventures, land developments, and other speculative schemes to investors who had no practical way to verify whether the underlying business existed at all, let alone whether it was likely to succeed. In 1911, Kansas passed what is generally considered the first American securities law aimed specifically at this problem, requiring companies to register their securities offerings with a state official and provide some basic financial disclosure before selling shares to the public within the state. The phrase blue sky law, used to describe this and the many similar state statutes that followed within just a few years, stuck immediately, precise etymology aside, because it captured so well exactly what these laws were trying to stop, selling investors a piece of literally nothing. Other states copied Kansas' approach quickly, and within a decade the majority of American states had passed some version of a blue sky law, creating a patchwork of state-level securities regulation that predated any federal equivalent by more than 2 decades. This meant that for most of the early 20th century, protection against fraudulent stock promotions depended almost entirely on which state an investor happened to live in, with enforcement varying widely in how seriously different states took the job. It was not until the Securities Act of 1933, passed in the wake of the Pecora hearings, that the federal government established its own baseline disclosure requirements, layering a national standard on top of, rather than replacing, the state blue sky laws that still exist in some form today. The sky the phrase referred to never actually changed colour. The laws it inspired kept multiplying regardless. For a stretch of years after the Civil War, New York needed an entirely separate trading floor just to buy and sell gold, because the country was, in effect, running on 2 different kinds of money at once. To help finance the war, the federal government had issued paper currency called greenbacks that were not directly convertible into gold on demand, creating a situation where gold and paper dollars traded against each other at a fluctuating rate, much like 2 different foreign currencies would. This made gold itself a tradable commodity with its own active market, and traders built a dedicated space for it known simply as the Gold Room, located near the stock exchange but operating as its own distinct trading floor, with its own indicator board displaying the current gold price throughout the session. The Gold Room became the centre of exactly the kind of speculative activity you'd expect from a market this specialised and this exposed to political and wartime news, since any shift in the war's fortunes or the government's currency policy could move the gold price sharply within a single session. The room reached its most dramatic moment during the attempted gold corner of September 1869, when Gould and Fisk's scheme to buy up the available supply sent prices climbing on the Gold Room's own indicator board, while a crowd of traders, by most accounts, descended into genuine chaos on the floor as the corner unravelled. Once the country returned to a full gold standard, and paper currency became directly convertible again in the years that followed, the practical need for a separate gold market largely disappeared, since gold and dollars no longer needed their own distinct exchange rate to track. The Gold Room closed quietly not long after, its specific function absorbed back into the ordinary financial markets once the wartime currency arrangement that had created it was finally resolved. The room existed because two kinds of money briefly needed their own separate market. Once they did not, neither did the room. For most of Wall Street's first century, a company's own director could learn tomorrow's bad news today, sell his shares this afternoon, and have done nothing that any court would call illegal. Throughout the 19th and early 20th centuries, corporate officers and directors routinely bought and sold their own company stock based on information the general investing public simply did not have access to, and this was widely understood as an ordinary, if slightly unseemly, privilege of holding a position of authority inside a company, rather than a punishable offence. The legal reasoning of the time, to the extent courts addressed it at all, tended to treat the stock market as a place where buyers and sellers were expected to look after their own interests, with no general duty for one party to volunteer information the other party had not asked for, even when that informational gap was as stark as an executive's private knowledge against an outside investor's total ignorance. Some early court cases did begin carving out exceptions, particularly where a director dealt face-to-face with a shareholder he knew personally and misled directly. But these remained narrow and inconsistent rather than any broad legal principle. The more sweeping change came gradually through the 20th century, built substantially on the disclosure requirements established by the Securities Act of 1933, and, more directly, on a specific rule adopted by the Securities and Exchange Commission in 1942 that made it explicitly illegal to trade a security based on material non-public information, regardless of whether the parties had any direct relationship with each other. Enforcement against insider trading, even after that rule existed, remained relatively rare for decades, and it was not until a series of high-profile prosecutions in the 1980s, overlapping with the same era as the junk bond and takeover battles, that insider trading became a genuinely prominent focus of regulatory attention, with penalties severe enough to function as a real deterrent rather than a theoretical prohibition. The practice itself never fully vanished. What changed was simply how seriously anyone was willing to punish it. A story that has circulated for generations claims that a member of the famous Rothschild banking family learned of Napoleon's defeat at Waterloo a full day before anyone else in London, and used that head start to make an enormous fortune trading government bonds. The version usually told involves Nathan Rothschild positioning private couriers, sometimes described as carrier pigeons in embellished retellings, to relay news of the battle's outcome faster than the official government dispatches could travel, letting him buy up British government bonds while other investors, still fearing a French victory, were selling theirs in a panic. According to the legend, once the official news of Wellington's victory finally arrived and bond prices surged, Rothschild sold his newly acquired holdings at a substantial profit, walking away with a fortune built entirely on a single day's informational advantage. It is a genuinely satisfying story, tidy in its mechanics and dramatic in its timing, which likely explains a good part of why it has been repeated so consistently across more than a century of retellings in books, documentaries, and casual conversation about the origins of great fortunes. Historians who have examined the Rothschild family's own detailed archives, however, have found remarkably little solid evidence supporting the specific version of the story as it is usually told, and some elements, particularly the more elaborate claims about the scale of profit involved, appear to have been invented or substantially exaggerated by hostile pamphleteers and rival bankers in the years after Waterloo, seemingly intended more to portray Rothschild's wealth as ill-gotten than to accurately describe how he actually traded. What the archives do support is that Rothschild's banking network genuinely did receive news faster than most competitors through its own well-organized communication channels, a real and unremarkable business advantage that later storytellers apparently found less interesting than a single dramatic bet on a single day's secret information. The real advantage was organizational and unglamorous. The story that survived was neither. Confetti thrown from office windows during a New York celebration did not start as confetti at all. It started as trash from a stock ticker that nobody wanted anymore. Stock tickers, printing a continuous strip of paper tape recording the day's prices, generated an enormous amount of discarded paper as the tape piled up in offices throughout the trading day. Most of it simply thrown away, once it had served its purpose of recording prices that had already come and gone. During the 1886 dedication of the Statue of Liberty, workers in the buildings along the parade route, watching the celebration pass below, apparently began throwing handfuls of this discarded ticker tape out their windows onto the crowd as an improvised gesture of celebration, using whatever paper happened to be sitting around their offices rather than any purpose-made decoration. The gesture caught on quickly as a distinctly New York form of civic celebration, repeated for subsequent parades honoring returning war heroes, championship sports teams, and visiting dignitaries throughout the following decades, with financial district office workers becoming an informal, essential part of the spectacle simply by emptying their wastebaskets out the window at the right moment. The practice gave the whole tradition its lasting name, a ticker tape parade, even decades after actual paper stock tickers had been fully replaced by electronic price displays that generated no physical tape at all to throw. Modern celebrations that still carry the name use purpose-manufactured paper confetti rather than any genuine ticker tape, since the machines that once supplied the real material stopped operating generations ago. But the name persisted regardless. Another case, much like the pink sheets, of a technology disappearing while the vocabulary it left behind simply refused to update along with it. The machines that made the original tape are long gone. New York still calls the parade by their name. Long before any American exchange existed, merchants in Amsterdam were already buying and selling ownership shares in a single company, a genuinely new idea at the time that would eventually cross an ocean and outlive the empire that invented it. The Dutch East India Company, chartered in 1602 to pursue trade with Asia, is widely considered the first company to issue tradable shares to the general public on anything resembling a formal exchange, allowing investors to buy a fractional stake in the company's voyages and profits without needing to personally organize or captain a ship themselves. This was a genuine innovation in how large, risky ventures could be financed, rather than a single wealthy merchant bearing the entire risk of a voyage that might sink, be lost to pirates, or simply fail to find profitable trade. That risk could now be spread across hundreds of investors, each holding a modest, tradable piece of the whole enterprise. Amsterdam quickly developed an active secondary market, where these shares changed hands among investors who had no interest in the shipping business itself, simply speculating on the value of a stake they could buy today and sell again whenever they chose, a level of liquidity that had not really existed for any comparable investment before. England followed with its own version through companies like the East India Company, and, later the South Sea Company, and the basic model, tradable ownership shares in a jointly owned venture, spread gradually through European commercial centres over the following 2 centuries. When American colonists and later the young United States began forming their own companies, the joint stock structure they adopted, and the habits of buying and selling shares in it, were imported wholesale from this older European tradition, rather than invented fresh on American soil. The Buttonwood brokers who gathered under their tree in 1792 were, in a real sense, working within a financial technology already 2 centuries old by the time it reached them. The company that started it dissolved centuries ago. The idea it introduced never really did. Decades before there was a central bank anywhere in the United States, New York's own bankers built their own private safety net, and for a surprising number of 19th century panics, it actually held. The New York Clearing House, established in 1853 originally as a practical convenience to simplify how banks settled the checks and drafts they routinely exchanged with each other, gradually took on a far more important role during periods of financial crisis. During several panics in the following decades, including 1857, 1873, and 1893, member banks that were fundamentally sound but temporarily short of cash, unable to meet a sudden surge of withdrawal demands, could turn to the clearinghouse for support rather than face an outright collapse. The clearinghouse's most creative tool was the loan certificate, an instrument member banks could issue to each other, backed collectively by the group rather than by any single bank's own reserves, that let banks settle their obligations to each other without needing to actually produce hard currency they did not have on hand at that moment. This effectively let the group of banks vouch for each other's short-term solvency during exactly the moments when public confidence was most fragile. The arrangement worked because New York's bankers, quite reasonably, preferred solving their own crises privately to inviting government oversight into their affairs, and for decades the system proved flexible enough to handle most panics without any formal government backstop at all. Its limits became clear during the particularly severe panic of 1907, when even the clearinghouse's collective resources were not quite sufficient without J.P. Morgan's additional personal intervention, and that same limit became one of the arguments used in favour of finally creating the Federal Reserve 6 years later, a permanent institution built to do formally and reliably what New York's private bankers had been managing informally, imperfectly, and mostly successfully for 60 years. The private system worked longer than anyone had a right to expect. Eventually, it needed help that only a government could reliably provide. Every trading day on the New York Stock Exchange ends the same way it begins, with a bell, but the closing version has become, in recent decades, considerably more of a performance than its morning counterpart ever was. For most of the 20th century, the closing bell served the same purely functional purpose as its opening counterpart, a clear, unambiguous signal that trading for the session had officially ended, giving floor staff and brokers a definite moment to stop executing orders and begin the day's settlement work. Starting more prominently in the 1990s, the exchange began formally inviting guests, typically executives from companies that had recently gone public, sports figures, entertainers, or public officials, to press the ceremonial button that rang the actual bell, turning what had been an internal operational signal into a moment companies now actively lobbied to be granted. The exchange itself recognized the promotional value of the ritual, offering it as a kind of small honor that generated free media coverage for the company or individual invited to perform it, alongside genuine goodwill for the exchange as an institution hosting the moment. Television financial news, which grew substantially as a genre through the same period, found the closing bell a convenient, visually reliable marker to build a broadcast around, further cementing its status as a small daily media event rather than a purely internal exchange procedure. The ceremony surrounding the bell has grown steadily more elaborate over time, sometimes involving speeches, applause, and a crowd of employees or supporters gathered on the floor specifically for the moment, a level of pageantry that would have seemed genuinely strange to floor traders from earlier decades who understood the bell purely as a practical tool for managing a busy, noisy trading day. The function the bell serves has not changed. The audience watching it ring most certainly has. For decades, the standard unit of trade on the New York Stock Exchange was fixed at 100 shares, and anyone who wanted to buy or sell fewer than that had to go through a slightly different door than everyone else. An order for anything less than the standard 100-share round lot was called an odd lot, and the exchange's main trading mechanisms, built around specialists managing orders efficiently at their posts, were not especially well suited to handling large numbers of small, individually modest orders alongside the larger institutional business that made up most of the trading volume. To address this, the exchange developed a separate class of specialist known as an odd lot dealer, who specifically bought and sold in these smaller quantities, typically pricing odd lot trades at a small premium or discount relative to the round lot price to compensate for the extra handling involved in processing so many small transactions individually, rather than in bulk. This arrangement meant an ordinary investor buying, say, 25 shares of a company for a modest personal savings account was, functionally, trading through a different part of the market's machinery than a large institution buying 10,000 shares at once, even though both orders were ultimately filled on the same exchange floor. The odd lot system existed quietly for most of the 20th century, a mostly unremarked upon but genuinely important accommodation that let ordinary individual investors participate in the market without needing the capital required to trade in full round lots every time. As electronic trading systems matured and computers could match orders of any size with roughly equal efficiency, the practical need for a dedicated human specialist handling only small orders diminished sharply, and the odd lot dealer role, like the $2 broker before it, faded out of the market structure once the technology no longer required a separate lane for smaller trades. The side door served ordinary investors quietly for generations. Eventually, the whole building simply had one door for everyone. A battle for control of a major American company has sometimes been won and lost not on any trading floor, but through the mail, one shareholder's signature at a time. Shareholders who cannot personally attend a company's annual meeting are legally entitled to vote by proxy, formally authorizing someone else, often company management by default, to cast their vote on their behalf using a form mailed out ahead of the meeting. A proxy fight occurs when an outside party, often an activist investor, or a corporate raider hoping to force changes at a company, competes directly with the sitting board for control of these votes, mailing shareholders a rival slate of proposals or board nominees and asking them to sign that version instead of management's own form. Winning a proxy fight does not necessarily require buying a majority of a company's shares outright, which can be prohibitively expensive. It requires convincing enough of the existing shareholders, many of whom might hold relatively modest personal stakes, to mail back a signed ballot, supporting the challenger's position rather than management's, a contest fought through persuasion, mailed literature, and phone calls rather than through the market itself. One of the most famous mid-20th century examples involved a bitter fight for control of a major railroad company in the 1950s, a battle waged largely through dueling mailings and public statements aimed at persuading small shareholders, many of whom had never given the company's management much thought before receiving a barrage of competing proxy materials asking for their vote. The episode demonstrated vividly how much power sat with shareholders who individually held comparatively little stock, but who in aggregate could decide a company's entire future through nothing more dramatic than checking a box and dropping an envelope in the mail. Proxy fights remain, even now, a genuine mechanism of corporate accountability, precisely because they let a challenger contest control without needing the capital to simply buy the company outright. Nobody on the trading floor decided that fight. A stack of mailed envelopes did. Wall Street, the actual street, runs for barely a quarter mile through lower Manhattan, narrow enough that two delivery trucks can make it difficult to pass each other, and yet the phrase built from its name has come to describe an entire national economy. The physical street itself has not hosted the bulk of America's actual financial trading for decades. The New York Stock Exchange building faces Broad Street rather than Wall Street directly, and most major banks, brokerages, and trading operations that the phrase Wall Street is meant to evoke have long since scattered across Midtown Manhattan, other American cities, and increasingly serve us with no fixed geographic location at all. Despite that, journalists, politicians, and ordinary conversation continue to use Wall Street as a shorthand for the entire American financial industry, sometimes meaning a specific bank's trading desk, sometimes an abstract set of interests opposed to those of ordinary workers, sometimes simply the stock market's daily movements, with the phrase's precise meaning shifting depending entirely on the speaker's purpose in a given sentence. This kind of substitution, using a place's name to stand for an institution or industry associated with it, is common enough in language generally, but few examples carry as much political and emotional weight as this one does in American public life. That weight can obscure as much as it reveals. Blaming an amorphous Wall Street for a policy failure, a market crash, or a corporate scandal lets a speaker gesture at something enormous and vaguely villainous, without specifying which bank, which regulation, or which individual decision actually mattered, a rhetorical convenience that has served politicians of very different persuasions for well over a century. The street itself, narrow and unremarkable to anyone walking down it today, carries almost none of the meaning that its own name has been asked to hold. The street is a quarter mile long. The word built from it has never known any such limit. The New York Stock Exchange sits only a few blocks from where the World Trade Center once stood, close enough that the attacks of September 11, 2001 left the exchange building itself physically undamaged but the surrounding streets impassable for days. Exchange officials, faced with a financial district that was simultaneously a disaster site, an active rescue operation, and a restricted security zone, made the decision to close the exchange entirely rather than attempt to resume trading amid conditions that made both physical access and basic communication infrastructure unreliable. The closure lasted 4 consecutive trading days, the longest shutdown the exchange had experienced since an extended closure tied to banking holidays in 1933, and it required an enormous, mostly invisible logistical effort to prepare for reopening, restoring power and communication lines throughout the damaged district, verifying the safety of buildings that firms depended on, and coordinating with displaced financial companies, some of which had lost their own offices entirely in the towers, to ensure they would have some functioning location from which to trade again once the bell rang. When trading resumed on September 17, the reopening itself was treated as a deliberate act of public reassurance, covered extensively by television news and framed explicitly by officials and executives alike as a demonstration that the country's financial infrastructure, however shaken, remained fundamentally intact. Volume on that first reopening day was unusually heavy, and the market fell sharply, a decline widely understood at the time less as a verdict on the economy's health than as a raw, immediate reaction to genuine shock and uncertainty, finally finding an outlet once trading became possible again. The exchange's own leadership spoke, in the days that followed, less about the numbers than about the fact that the floor had reopened at all, a message aimed less at investors than at a city and a country looking for any sign that ordinary life, including the mundane ritual of a trading bell, could still resume. The floor went quiet for 4 days. When the bell rang again, that alone was the point. None of this was ever really about the ticker tape, or the bell, or the room where the gold traded. It was about a few hundred years of people trying to build something orderly out of an activity that is, underneath all its rules and rituals, still just a crowd of strangers guessing at the future together, and hoping to guess better than the person standing next to them. The wall came down before the country that built it had even finished naming the street after it. The tree came down too, long before anyone thought to preserve it, and most of what grew up in its place, the seats, the specialists, the hand signals in the pit, the $2 brokers moving from post to post, has come down since as well, replaced by screens that do the same job faster and with none of the noise. What tends to survive, oddly, is not the machinery at all, it is the habits underneath it, the urge to corner a market, the appeal of a story that explains a fortune too neatly, the comfort of a bell that tells you, without ambiguity, that the day has ended and you can finally put the numbers down. Somewhere in the last 45 stories, if you were listening closely, one of them probably reminded you of something you already knew about people and money, something you'd have called common sense if a stranger had said it to you at a dinner table, rather than dressed up in a historical costume. That is not an accident. The instruments changed, the paper became electricity, became light in a fibre optic cable. The people standing behind all of it, buying, selling, panicking, recovering, telling each other stories about fortunes made and lost, changed hardly at all. The floor is quieter now than it has ever been. The people who once filled it are still out there somewhere, doing more or less the same thing.